without further ado, let's kick off this conversation with Julie Conroy.
Great. Thanks so much, Lee. And thanks to all of you for giving us an hour of your valuable time today. So 2020, this time last year was when the U.S. market went into lockdown, and, it's really, it marked the period of the world turning upside down for many of us. Thankfully, I think we've got a light at the end of that pandemic tunnel. But as we look at what took place over the past year, fraudsters did not take any time off by any means. And that holds true for a variety of forms of fraud. Certainly they had a lot of fun driving trucks through stimulus fraud, but synthetics were also an active form of fraud as well. Now, I've been looking at the topic of synthetics for years. It's something that is top of mind for a lot of the financial institution executives that I talk to. And one of the challenges, one of the many challenges around synthetics is that there is really no common definition, even within organizations. I've interviewed folks where I've asked them what their definition of synthetics is within a big bank, and they will give it to me, but then they'll say, but if you ask my counterpart in another business unit, they will have a slightly different definition. So that definitions piece is a challenge. Identity fabrication, just starting from the ground up and nurturing a net new identity from scratch, that's certainly one that is pretty common across most folks I talk to. Everybody says absolutely that is synthetic. Identity compilation. So as you have data breaches and you bring bits and pieces of identity from different breached data, a stolen social security number here, a stolen name over here, date of birth, and you put them all together and create this Frankenstein identity. Most organizations consider that to be synthetic, although there have been a handful that I've spoken with over the years that if it is somebody's genuine social security number and you can get to the victim, and you do get to the victim through skip tracing, they consider that to be identity theft. Identity manipulation. You take a stolen identity and you just tweak it here and there. Change a number in the social security number, adjust the name just a little bit so that, as it gets reported to the bureaus, it's different enough that it sets up a net new record. And then CPNs is another one. I would say this one is probably the most controversial among the banks that I speak with about whether or not they consider this to be synthetic. A credit profile number is, for somebody that has bad credit, they will go to a credit repair agency who will set them up with a new quote unquote tax ID number to evade the bad credit that they've racked up. And some believe this to be a form of synthetics. Other banks I talk to believe this is more of a form of first party fraud. With all of that, unquestionably, the challenge is there for many institutions. Synthetics are very hard to detect. Oftentimes they get written off as credit losses and roll off as never pay defaults or straight rollers. Or you have the case where they nurture their identities, they set up networks of identities, often with fraudulent merchant storefronts across an institution, across many months and even years, and then they finally bust out, and oftentimes that bust out has upwards of a six-figure price tag. So why has synthetics been such a big topic in recent years? We've been seeing a number of growth drivers behind synthetics, and again, particularly in the US market, where it is easier than in some other jurisdictions to set up synthetics. We've had 39 billion data records breached since 2013. So there is just an ample supply of raw material for the organized crime rings that are behind many of these synthetics. In 2011, the US started randomizing its social security numbers, taking one valuable tool out of the toolbox for FIs who were trying to detect synthetics, since some of the check digits and the things that looked at logical consistency of social security numbers no longer existed. after that randomization. And then over the course of the past decade, really up until the onset of the pandemic, we were in this gradual economic recovery period, which had institutions loosening their credit and making it much easier for these synthetics to set up new identities by springboarding as an authorized user off of an existing credit line, or just very patiently nurturing and obtaining credit for the identity fabrication attack vector. So with that, we've definitely seen an uptick in the proportion of identity fraud that is synthetic. So as you look at how these rings do it, this is an anatomy of a synthetic fraud attack. This is based off of an actual prosecution that took place in September 2020. There was an organized crime ring that took over 13 financial institutions, both credit unions and banks, for over $1 million in losses. The good news is that it was one of those cases where we did see a prosecution. So how they did it was, largely with the Frankenstein fraud approach, by using stolen Social Security numbers from data breaches to compile new identities. They used these identities to apply for accounts with relatively low barriers to entry. And so some of these accounts started out, some of the identities started with just a mobile phone number. And, that was the first point of entry. Others, there was a secured card, which again has relatively lower barriers to entry. And, then once you have the established accounts, then you can do some springboarding and add an authorized user to that account to then further bolster the network of identities that are being used. This credit is then patiently built over time, transacting on the accounts to a small degree, and then over time applying within that same institution for a credit card, in some cases an auto loan. And then in this case, it was about 2 years when the ring busted out and left this collection of institutions with over $1 million loss. As I talk to executives at financial institutions, there's a lot of concern about their ability to control the issue. Now, the good news, and Lee's going to talk about this a bit during his discussion, is there are a number of tools and analytical scores that are now available in the market that can really help with this. But at the same time, having an understanding of how big your problem is to justify your business case is often the starting point that a lot of institutions are still not quite yet out of the starting blocks. So as we survey financial institutions, and we conducted this survey in late 2020, we asked them, to what extent do you think that synthetic identities are a bigger challenge than identity theft? And as you can see here, 70% of the folks that we interviewed did agree with that. And then in that same survey, we asked about a number of different types of fraud and the extent to which institutions felt that their control framework was able to adequately detect attacks and prevent losses. And as you can see here, half of the folks that we surveyed did not think that their control framework was adequate to detect synthetic identities. So still lots of room for improvement in detecting this. And this is where it goes back to that name of the report that Lee was talking about, where we're calling them diabolical charge-offs. And I wish I could take credit for that term, but that actually came from one of the financial institutions that I interviewed for that report, because they can be so hard to detect at the front door. And often a synthetic will look very similar to somebody that might be new to credit or new to country and potentially a great new client. Another big challenge and why synthetics are considered diabolical by so many institutions is the fact that so much of identity fraud, synthetic identity fraud, winds up in collections queues. And so it isn't recognized as fraud at the front door. It rolls off as a credit write-off. And then not only do you have the loss hiding in your credit portfolio, but you've got valuable collector time being spent trying to collect from somebody that never even existed. And so, as you look at where institutions are funding business cases to address this, there were a number of institutions that I talked to that said, because in the past 5 years or so, we're starting to see some fundamental shifts to delinquency curves that are really only explainable by synthetics. We're seeing in some cases that the credit side of the equation and the fraud folks are coming together and collaborating on the business case to deploy some more robust defenses for synthetics. And this isn't just a credit risk problem, it's not just a fraud problem. There's definitely AML concerns around this as well. We've seen the Federal Reserve put together a number of position papers over the past few years, which I think is a clear signal that synthetics are increasingly on regulators' radar screen. And as I interviewed fintech lenders for this piece of research, and fintech lenders oftentimes have a much more integrated function with AML and fraud working more closely together. And many of the fintech lenders said that, we're certainly concerned about the fraud risk, but also, there's an AML concern as well, because if I've got a bunch of synthetics on my books, it means I obviously do not know my customer, and that will get me in trouble sooner or later with my regulator. So as you look at, the solutions, and I spoke earlier about the good news that there are a number of solutions that can help on this front. We are seeing that a number of institutions are planning to make substantive changes to mitigate application fraud over the next couple of years. As you can see from the survey that we did late last year, 16% had already upgraded in making a substantial change to their control framework, and another 78% said that they were likely to do so over the next couple of years. And as you look at the types of solutions that can be very effective helping with synthetic, 82% of the folks that we surveyed believe that data exchanges and consortia with shared fraud and reputational reporting are very helpful, as are analytically driven synthetic detection models. And often these synthetic detection models will look at the characteristics of how this identity is building credit. They'll look at, how did we first see this identity? Was it an authorized user that was springboarding off of an existing account? Or did they appear organically and build credit more like a normal person would? The eCBSV is also a newer tool in the toolbox. And as we look at how the pilot for the eCBSV, which that is the ability to directly and in real time ping the Social Security Administration's database to see, does this name and Social Security number match? So there is optimism that that will be a valuable new tool in the toolbox. But it won't be a silver bullet, and especially as with its initial construct in the pilot, where there is no fuzzy matching associated with that. Most of the institutions that I have spoken with that either are currently in the pilot or plan to be said that the false positive rate is pretty high, and also there's concern about there's some very overt permission language that the consumer has to sign off on in order to permit this. So again, one more valuable tool, but certainly not a silver bullet. And another tool that we're seeing folks increasingly deploy, and actually the pandemic has, I think, accelerated this, is identity document authentication. So having the ability to take a picture of that driver's license, analyze the driver's license to make sure that it is a genuine document, and then in many cases do the selfie match. That's also another really valuable tool for application fraud in general, but also for synthetics. So as we look at some of the key takeaways from this research, it's as I interview financial institutions and fintech lenders, we're certainly seeing that synthetic fraud continues to be on the rise. The good news is some folks have mustered the funds for their business cases. They have deployed compensating controls, and they're getting their arms around it, particularly at the front door. But as I said earlier, some are in just the earliest stages of this journey, and they haven't even yet really gone into analyzing their credit write-offs and looking at those portfolios to determine just how big their problem is. But we are seeing that there is appetite because of the fraud, the credit risk considerations, as well as the AML concerns. And as with all forms of fraud, there's no magic answer here. So it really does take addressing the problem both on the front end as well as the back end to effectively control it. So with that, I think that's a great time for me to turn it over to Lee to talk about some of TransUnion's insights and some of the ways it can help.
Thanks, Julie. And if you could click me through to the next slide, that would be great. As Julie said, we know that 2020 was the year that the world turned upside down. I think many of us, myself included, went into the year thinking start of a new decade, 2020, the year of perfect vision. Everything was set up for a lot of success. We got disrupted, and hopefully we were all glad that we've been investing in digital transformation for years. So we already had a lot of the pipelines in place that we needed to be able to handle more of a digital direct-to-consumer type of an interaction. But government mandates came along, and concerns over the unknowns tied to COVID, it forced us beyond where we'd been before with remote transactions of every kind. And in the world of synthetic fraud, this led to many conversations in consumer credit around the threat of increases in synthetic fraud. This, like Julie said, this is the topic that I get asked about for sure more than anything else when it comes to identity and fraud out there, not even close. And so I think as soon as we understood that everybody was going to have to go digital, that you wouldn't be able to see your customers face to face, that the, where channels maybe had been 50-50 or 30-70 or whatever in terms of digital versus in person and so forth, there are now all being done 100% remotely due to government mandates. Everyone expected that because you didn't have that face-to-face world, that consumer credit was going to see an onslaught of synthetic fraud attempts. As we walked our way into a year that would be full of COVID impacts to our business life and life in general. And if you can go to the next slide, Julie. But in 2020, very little went as expected. It was more about learning, I think, than it was for predictable outcomes. Significant changes happened very quickly. We all tried to triage the situation. We tried to stabilize our businesses, serve our customers, our staff, students, family, everything in the middle of the situation we were in. And a couple of things happened that maybe when we first started brainstorming what was going to happen during the pandemic, we hadn't really thought about. First off, businesses put their minds to work to try to limit the loss of risk and exposure and support their consumers who are seeing digital scam and phishing attacks kind of off the chart, right? So roughly, let's say about a third of us probably were hit by some kind of a digital scam as COVID opened up within the first 90 days or so, according to a lot of surveys that you look at out there. All the businesses converted to digital very quickly, trying to keep their doors open. There was a lot less originations marketing, so there's less supply. Tightened credit risk policies in some cases, so a lot of times there were less loans to be had, and more scrutiny was being applied to new loans being open, and there was increased account takeover security even as everyone understood the phishing, the smishing attacks were ramping up very quickly, and businesses were trying to protect their consumers and their accounts against it. Secondly, federal and state government programs, they were hyperactive, trying to find ways to help consumers find a way to make it through, at least temporarily, to float their way through the crisis, minimize the impact. And what that offered were things like, some of the largest federal stimulus packages we've ever seen, $2 trillion for consumers and businesses. A lot of households were getting between $1,200 to $3,400 to help them get through the initial stages here. And so there were totally different patterns of behavior than anyone expected from there, but also there's large sums of money that became brand new types of targets. Almost 5 million loans went to businesses and nonprofits in a hurry, right? There were businesses who told us that they might take a couple hundred small business loans in a year that took tens of thousands within a couple of weeks. And things like the CARES Act, it stemmed evictions, liens, judgments, collections, repos, just all normal parts of everyday life with delinquent debts that were kind of put on hold or were eased up during that time period. So the environment was changing very rapidly. It wasn't just what was happening due to COVID, but all these responses are going to have knockdown effects as well. And then thirdly, really interestingly, as we monitored credit scores over time, they remained really stable. So despite the fact that we all knew we had record job losses, hour reduction impacts to normal income, the credit scores were buoyed really strongly. They held on for a long period of time and are actually still in pretty stable condition right now. If you looked at, for instance, the share of super prime consumers with credit in Q3 2019 is at 24%. Q3 2020, it was at 26%. If you look at the other end of the spectrum at subprime, in Q3 2019, it was about 25%. Q3 2020, it's about 23%. So relatively flat, if not slightly favorable in terms of credit scores despite the environment. So all those factors came together. And if you can go to the next slide, Julie, we're going to show this graph here as we monitor at TransUnion the highest scoring band within our synthetic fraud model. So this is specifically, this one is monitoring an FCRA base score. So it's using credit data, looking at the makeup of credit reports and understanding which ones have a high probability of following a synthetic pattern. And we monitor how much they're used in acquiring new accounts, as well as from our subscribership looking at credit inquiries hitting as well. And if you look going back to 2019 all the way through 2020, you can see that I think surprisingly for pretty much everyone, the synthetic rates were really held in check from the COVID period that begins around Q2 2020 there. In fact, cards saw a 29% reduction for new account incidence rates in Q4 2020 versus 2019, and auto was down 21%. So those are pretty significant numbers for what were the some of the largest contingencies for synthetic fraud incidence rates when it came to inquiries and to newly opened accounts. And there were some other market factors as well that contributed to, we think, the synthetic fraud incident. So beyond just the ones that we mentioned a second ago, many in early in 2020 were focused on growth to support their existing customer base, and they're managing risk for new originations when they came in. So that immediate concern popped up, and so the defenses increased as well, right? Everyone saw I need to go digital only. They're expecting an increase, and so they tightened their criteria. They focused their strategies, bringing together digital personal ID tools and mitigating the fraud loss risks. Secondly, there were brand new, highly lucrative attack vectors, right? When we talk about those federal and state government relief programs, right? Those are brand new opportunities. You think about like those PPP and government-backed business loans. If there's a loan opportunity where you could walk away with $2 million+ in 1 or 2 or 3 loans, versus your normal activity with synthetics of going after a $10,000 credit card or a $20,000 personal loan or a $30,000 automobile. This is an attractive brand new target that surfaced, and it was pretty well publicized that the volumes were very high in short periods of time, right? And fraud perpetrators know the environments pretty well and know what to expect. So when we think about consumer credit, this is a good reason to see some of the volume steered away and why maybe it was a little bit lower, because we know that there were synthetic IDs being used in different ways in those small and medium business loans that went out as well. And then thirdly, one of the bigger things is a decent portion of synthetic fraud, like Julie said, is that CPN type activity, those credit privacy numbers, where a lot of times you're actually not just dealing with a fraud perpetrator, but in a lot of cases they're actually a victim as well, in that they're enticed by someone who is advertising as though they're a legitimate credit repair company, but what they're doing is facilitating a synthetic identity on behalf of their quote-unquote customer who's met them on the internet, and they'll sell them what they call a replacement for your Social Security number, which ultimately amounts to a felony, often unwittingly, for the person who's buying that. So there are certainly cases where someone is committing a crime, meanwhile they're paying someone to facilitate that service for them, and all of that to say that the demand for that kind of credit repair would be down during the pandemic period, given the unforeseen positive impacts of the loan forbearance, the lower collections, repossessions, right? If no one's coming to take your car away, et cetera, then there's less of a demand for you to suddenly get desperate. What we refer to as like a desperate fraud, where you're turning online to find who can help me to solve this issue that I'm having, to get away from the things that are pulling my credit score down, or get me access to a new loan in a hurry. And that's where a lot of times they run into these types of things. So despite all that, right, despite the fact that when we look at the data on certain segments of the consumer credit market, we see kind of a managing of the amount of synthetic fraud that happened during the first waves of the COVID pandemic period. And here we're living in kind of the knockdown effects. What we can see through this Aite study is that business leaders remain very concerned about synthetic fraud. Going into 2021, it's their top concern, and for good reason. Julie pointed out some of the challenges, right? A lack of a common internal definition, those forbearance and accommodations that I just mentioned that are contributing to holding down the demand for that CPN type of synthetic fraud, which is probably at least half of it a lot of times in recent years, right? With those accommodations and forbearance rolling off, repossessions resuming, evictions, all sorts of other things, right? There is the potential for that financial distress to start to increase for consumers, especially those who find that their jobs aren't rebounding as quickly going into this next year. So I think for good reason, more than 3/4 of executives that were surveyed said that they have some serious concerns here, and that they have plans to shore up their defenses going into the next year. So I just want to give an example here of what it looks like to see a synthetic fraud attack, a simple one. I appreciate the example that came from Julie earlier from unfortunately some businesses that ran into this issue and ended up losing money to those consumers. Thankful for law enforcement, but definitely after speaking to a number of law enforcement folks over the last 5 years, every single conversation I have with them says the number one defense here is going to be prevention, not in trying to chase them down afterward, pay and chase, right? So fortunately, this is an example where we were working with a luxury auto dealer. There's a synthetic fraud attempt. A very brazen individual came in. They were looking for $380,000 in vehicles for their small business. The business was in Texas. The owner went to a regional dealership, right? So you're staying in the general area. Selected 5 vehicles. Say, I need these for my staff. You look up the business. It's real. There's a genuine LLC. Like a consulting type of a firm that exists. He looks creditworthy. The story is plausible to some degree. The only thing that alerts them is a synthetic alert, and we're going to talk about this in just a minute, but they got an alert back that serves as a red flag for them in real time to say, okay, I need some more documentation to verify you as the buyer. And even though they had some cash on hand for a down payment to make the deal, the lender on the first day they were using the tool here said, okay, well, we need to see some more documents. And so the consumer went away, supposedly to get the documentation, but never returned. So when they reached out, they said, hey, can you tell us a little bit more about why this looks this way? Because they hadn't dealt with a lot of synthetic fraud in this way in the past. They just heard about it as an issue, and now they're looking at potentially a real live one. And there was a lot of upside here. If this was a genuine consumer, that's a really great sale to move 5 vehicles at once with someone that seems to be financially viable. And what we learned is underneath this individual, we saw at least 13 associated identities. You've got over $500,000 of either bad balances or currently open debts. There is a business. There's a driver's license, but they're not in the same state. Their residences spread out all across the U.S. Tied to these identities that have been used by this individual. They've presented themselves with employers as a pharmacist, a VP of consulting, and a construction manager, all within the same couple of months at different financial institutions. There's a criminal history of identity fraud, personal business tax liens that they're probably sheltering from and attempting to shelter from by hiding their true identity, and even filing victim fraud claims. So claiming that debt that they're being chased down for, they never applied for it. It wasn't really them, and trying to use their false identity that they created as though someone had stolen their identity, and all the while using all sorts of AKAs, with different names and nickname combinations and things of that nature. So you can see that obviously the upside for the business, if this was a genuine consumer, is great, and they look great on the surface, on paper, but underneath there's a lot more to the story, and so it has to be detected in real time in a real way, but also dealing with that opportunity cost of what if you're losing out on a good deal. So where are we at? From where we sit, there are multiple factors that could point toward a potential rebound here, right? So kind of that triangle of fraud, your rationalization, pressure, and opportunity. And we think about, probably we went through a very similar cycle back in around 2011 timeframe. Julie was referencing how we had reached kind of the peak of a really strong swing in the economy, a recovery from prior days that many of us were here for in 2008 to 2010. And remember in 2011, the economy was rebounding from a serious recession. There was pressure. Many were looking for work or had jobs, but the future felt uncertain for them. Fraud for a living, card manufacturers saw their chip and EMV train. The chip and EMV train was coming for them and shutting down that side of the business. Opportunity lending started to ramp back up. Julie mentioned the Social Security number randomization, which is great for victim fraud prevention, not great for businesses that started dealing with synthetic fraud ramping up. Data breaches were on the rise, opening up wealths of PII to pull from for what Julie was calling Frankenstein IDs, and loopholes for that have been used for traditional first-party fraud. Realized that you could repeat them by creating a brand new profile. So in 2011, we saw the pressure, we saw the opportunity, and then the rationalization. If you read any of the stuff that was written back in the 2012 to 2015 timeline, at some point you're going to see somebody referring to synthetic fraud as touted as a quote-unquote victimless crime. It allowed the fraud perpetrators to depart from violent crime, like Grand Theft Auto and armed robbery, or even identity theft and hurting victims and ending up in court with a victim on the other side of it, right? Instead, they saw that, hey, this is just the bank. They're writing it off as a credit loss or a chargeback, a charge-off, and so they were able to rationalize their way into this kind of behavior. So rates of synthetic fraud, they increased modestly right after that, like about 7% year over year the first couple of years, but within 5 years, the rate had doubled. Right, so if we just think back to what we had seen, right, with these major increases going up from 2011 to 2017, we just think, could we be in a cycle that looks maybe very similar here, right? We're coming off of the pandemic period, and you're seeing these other targets start to roll off, right? If there's not more stimulus coming in the future, right, there's no additional targets to go after. If you have the financial distress ramping up, which comes with the return of repos and collections and delinquency reporting and things of that nature, then we may very well be at the beginning of another growth curve or a rush of synthetic fraud. If we see the threat of financial hardship going up for consumers and those targets going away, then they'll return, or they can return back into the consumer credit arena, right? And as Julie said, there are options and help is on the way. We're really excited about things like the ECBSV program, which provides the ability to verify a name, date of birth, and social against the Social Security Administration's records. But there is no, as Julie used the term, silver bullet. And I find it fascinating how, as much as individuals like to reach out and talk about this topic of synthetic fraud, it's amazing to me how many times I hear, well, all you need to do is, and then fill in the blank. But I think back to when we randomized the Social Security numbers, right? Before that, the buildup was consumers are having their identities stolen with the Social Security numbers because of the numbering convention going in order, and it's a known it's a known pattern that you can look up online, et cetera, et cetera. So the answer is let's randomize. But what that leads to then is now here's a new behavior of creating synthetic IDs, and they're not detectable because of the random Social Security numbers. So I think that's something any of us who have spent a lot of time in fraud and identity are aware of, is that for every action, there's going to be a reaction, and something else will happen. So we're going to talk about that in just a second, right? Fraudsters are busy devising new schemes, more sophisticated ways. We think the forecast for synthetic identity fraud, to Julie's point in her study, it seems bleak with increases to the numbers. And as she said, for many years, many just wrote it off and took it as a credit loss to expect, that you just had to accept it. Let's talk about what can you do to prepare? How can we be ready for this next season if we're anticipating it to go up? So I'm going to offer three things that I'd like to talk about here. Firstly is create clarity and make a pathway to meaningful action, right? So many are frozen with the first step. So Julie mentioned coming up with a definition can sometimes end up spending months or cycles for individuals. And I'd say the best thing to do to get started is just get started. Start with what you know, and then deal with the things that you don't know. You can deal with this lack of transparency by creating clarity within your organization around what is synthetic fraud. And then secondly, start to target what specific improvement metrics do you want to see for this type of fraud, right? So everyone immediately jumps to the conclusion of let's stop synthetic identity fraud. Well, maybe first you could just try to say, well, what is the rate at which my existing customer base looks to be potentially synthetic? And what might the dollars at stake look like? And then look at my originations. What percentage of applications and or booked accounts that are getting through look to be potentially synthetic? And then create some targets for improvement, as opposed to starting the conversation all the way out, there should be zero, because ultimately you're going to find yourself in a situation making trade-offs you may not be able to make. And then thirdly is activate some solutions that support your policy. You know, firstly, you got to have a policy, but then secondly, you got to put some solutions in place that are going to help you deal with that, right? Once you have an agreed definition, if you don't have an agreed definition, you can't have a policy. If you don't have a policy, there's not a lot of action then to mitigate the threat. And oftentimes, as Julie brought up, there are some organizations that take the AML, KYC concerns very seriously. There are others that just because they haven't been able to define it or uncover it, have simply held this as a credit risk. But I think in the coming months, as you see more and more financial distress, those that even fit that definition of what we called a CPN, that maybe didn't have the same type of intent at the onset as a big, international identity crime ring, they are going to become more and more of a risk because they've been underwritten with the pretense that they look a certain way based on the credit profile or the assumptions of what you underwrote them with. But there's probably a whole history of things that's completely hidden, or an unknown history, and they fabricated a picture for you to use to get access to the loan with the intent to get access to the loan. So even if they intended to repay, there's a decent chance that they actually don't have that ability to pay, and you may not fully understand that ability to pay in the background. All right, secondly, implement a targeted ID proofing program that maximizes the digital technology, and the big data assets that are available to you. So ID proofing historically focused very heavily on verifying that the applicant is who they say they are. Do they own this identity? And that's the right thing in a consumer victim type of crime scenario, and you build everything around that paradigm. The increased scale of credit abuse and synthetic fraud demands some changes, though, to those ID proofing paradigms, which account for skilled credit manipulators who attempt to fabricate a reputation that lets them blend in with the herd so that you don't detect them. Right? ECBSV is just the kind of thing we've all said that we needed for years. You need source validation of the SSN when a consumer offers their consent. But as we started looking at this, many businesses are finding that just another consent is something that they don't want to burden their applicants with, at least not most of them, especially when most of your consumers that are coming in are genuine. They're not synthetic, they're real. And so carrying them through to yet another consent and another stage of verification is not something that a lot of them are excited about. As Julie pointed out in a study you'll read here that 63% of executives that were surveyed, they're optimistic about ECBSV's potential, but to use their term, it's not going to be a silver bullet, right? So utilizing big data assets, many are finding a lot of success in identifying the riskiest transactions, like the case study I showed you a little bit ago, right? The most successful models are going to take advantage of both perspectives. And when I think of the two different perspectives that you want to look at the ID data from, first is what I refer to as a vertical. It's just imagining you printed out someone's credit report and you're looking top to bottom at that credit report. What's the makeup of that credit profile? Very, very important intelligence embedded in there. There are behavioral aspects that are very common with synthetic fraud that can start to separate them out with a high degree of accuracy from ordinary consumers. And then secondly, it's horizontal. You want to use identity attributes and cut across all the identities, look at the different PII elements, and see how they've been used across a large-scale network to give you a complete picture. Secondly, aside from purpose-built models, behavioral attributes, those sorts of things that take that vertical and horizontal view and convert them into a real-time indicator. That's your lead indicator, right? It is a score, a model, attributes, things that can tell you this looks to be potentially synthetic. Secondly, is you want to have the layer of device intelligence. Devices have been increasingly become centralized tools for interacting with financial institutions. With digital transformation initiatives we've all been working on for the last 15 plus years, right? And now with COVID response policies, it's been fueled to a level like never seen before, right? But unlike traditional PII that has standard formats, syntax, devices don't have a common format or identity standard. But when they're combined, it can be very powerful to look at the personal ID elements combined now with the digital ID elements, and your confidence level in a decision starts to increase very, very rapidly, so you're more confident in the decision you're making. And then thirdly, as we mentioned here, the Social Security number source verification, including ECBSV, gives you a brand new type of detection that we've just never had before that's going to give businesses a really strong chance to get a type of verification that we haven't seen before. And then our third recommendation here, apply a synthetic-focused authentication method to resolve your high-risk identity cases. And it's important to do it in real time for sure, right? The moment that you send someone away, we all know that they're gone. So if you're the fraud or the risk manager trying to convince the marketing or the originations manager, the line of business manager, that they need to add a bunch of more step-up verification for every single consumer, you're not going to win that discussion, and the numbers just don't work out. I'm telling you, they don't work out. Working on both sides of the business, you know that is not going to happen, right? You have to create something that is friction right for the consumer and ensures that you can actually become part of the solution and help the good consumers to get through, to find that express lane and to get through. And those that need more help and or need additional verification because they may not be genuine, then you can take them through those step-up verifications, but make them as frictionless as possible, as appropriate for the situation, tied to the level of confidence that you have in the identity, the level of trust that you can see. So two of the most important ones that I would point out here for synthetic fraud authentication. In the past, when you saw a high-risk identity, you probably did one of two things. One, you either sent them a knowledge-based authentication or a one-time passcode in an attempt to verify that they are who they say they are. Or two, you introduced a request for some sort of documentation from them. You asked for copies of utility bills, of their social security card, of various items like that. And those have all been helpful to try to mitigate fraud, but also they can be an inhibitor to account growth, not to mention the fact that, we can all be socially engineered, right? There are ways that people who spend all day, every day doing fraud can learn to get through, right? So synthetic-focused authentication methods are going to address the risk that you have today if you don't realize that asking a knowledge-based authentication will be completely unfruitful because they can answer every question. So first off is that eCBSV process, Social Security number verification, I would actually encourage a consideration here, and I think a lot of financial institutions are looking at it this way. Ask for the consent and use that as a step-up authentication method. Maybe you don't want to ask every consumer for another consent going through your originations process, but if you can get it down to the 2%, 1%, 0.5%, 0.25% of the most risky synthetics that are coming through, then those are the ones to look for their consent and take them through that Social Security number verification. Secondly, and this can be helpful for more than just synthetic fraud for sure, but a lot of businesses are finding success in touchless document verification. The key is, right, from a COVID and COVID response perspective, and now the heightened expectations of your consumers, it's real time. You don't have to touch their identity documents. They simply scan their front and back of their license or scan their passport with their phone. We triangulate that data in the background, make sure it verifies with the information that exists on file. You can add a selfie for a liveness test, as well as triangulating, making sure that the face is unique, that it matches the identity document, and the identity document, the data on it matches what's available on that consumer, right? So you can step up and do it in real time and feel and gain a lot more confidence in the decision that you're making. So in conclusion, right, so how do we want to protect our businesses and protect consumers against growing synthetic fraud in 2021? First is prioritize a synthetic fraud strategy for your organization, right? That can actually give you the ability to get moving, to make some traction. Secondly, implement a targeted ID proofing program that uses technology and big data assets, focus on those lead indicators that can help you ensure that you have a friction-right experience, right, so that your best consumers, you're giving them that expressway through. And for the most risky ones, which can be found through those behavioral aspects in the vertical and horizontal view and the digital footprint they leave behind, right, those are the ones you want to take through step-up authentication. Then thirdly, for those that are higher risk, that you don't have the same amount of trust content available on them, your step-up authentication needs to be synthetic focused and not using traditional paradigms that focused on ID theft, but actually address this type of a unique first-party type of fraud when you're authenticating them. All right. So thank you all very much. This is hopefully very helpful. And at this, I think we're going to take a look and see if we have some questions that have come in. Let's see here. First one, do you expect an increase of ID fraud with the increased state unemployment websites that were breached? I'll offer my thoughts, and then Julie, love you to weigh in here. But I think my concern is a lot of people talk about with data breaches, whether that leads to a great deal of synthetic fraud. There's some evidence that data from these breaches is used for synthetic identity fraud, especially where you have these sites, for example, that sell CPNs, and they're now advertising that they'll tell you which state the Social Security number is from and the year, the age band, so that you can match yours to it when you buy it and hopefully sail through ID verification. So they are used in some cases like that, but honestly, I think the account takeover and the ID theft risk is massive. And when I look at the growth rates of account opening ID theft versus synthetic fraud, I'm super concerned on that side of things. But certainly they could be used for synthetics as well. Julie, do you have a perspective on that?
Yeah, I completely agree, Lee. I think the concern is more on the identity theft side, and that is consistent with the discussions I've had with both financial institutions over the past year. You know, there was a big uptick in application fraud tied to identity theft, because if you're going to be filing for unemployment in somebody's name, you generally need to have an account in their name to send the funds to, although not all states even check that. We actually published a report today that sizes the extent of the unemployment claim fraud in 2020, and it was massive. it was really big.
Great. Yeah, looking forward to reading that one too. Julie, I think this is another good one for you as well with the study you all did. There's a question here that says, are machine learning and AI solutions included in the third-party analytically driven synthetic detection models? And do you see companies developing their own AI ML solutions to crack down on synthetic fraud in the coming years?
Good question. So yes, that is in that bucket, and I'm seeing a couple approaches. I'm seeing that some institutions are going to third-party providers and looking for their help, either leveraging their off-the-shelf score or having them come in and build a score. I'm also seeing that there are institutions that are leveraging their risk engine and bringing in a number of different data inputs to that risk engine to construct a score. And importantly, in the latter case, a lot of, the best practice there is to have a identity theft score at the time of new account opening, as well as a separate synthetic score. You want to have that population bifurcated because to Lee's point earlier, the treatment mechanisms for identity theft versus synthetics will be different in most cases. KBA and OTPs don't work with synthetics because they will know the answers to all the KBAs, and most likely they will have a mobile phone in the name of the synthetic.
No kidding. I think that's been part of what's been so frustrating for a lot of organizations is you have all these great process flows built out for your fraud and identity management, and it just turned out that they could just sail right through them, and you actually end up building up the trust factor on and inadvertently contributing to the scheme in a lot of cases. And one other thing I would just mention on that point too is, two other things. Firstly, some of it you catch by accident. So somebody was asking here, are there tools that can identify synthetic fraud in your portfolio? Yeah, for sure. But also, I think you'd be surprised how many of you actually catch just by accident with your existing tools that probably are meant to deal with ID theft. So things like social security number used on multiple consumers, or address mismatches, or some of your digital tools, right? So looking at IP address mismatch with the physical address that they're at. And if you look at some of those other indicators today, email age and email popularity, there's a various number of alerts that we have today that will fire very commonly on synthetic fraud. So some of those you're probably seeing at least as moderate risk. You're just not fully understanding and classifying the scheme right. And to Julie's point then, that leads to the wrong verification method. So it's critical to start, even if you detect some of them today and you're turning them away and say, oh, we've got a decent defense strategy by accident because we seem to be turning a lot of them away. The ones that are getting through are probably even more dangerous, right? Because they've understood your authentication process and they've been able to pass through. So to Julie's point earlier, a lot of times you're looking at these IDs that may be groomed for 6 months to 8 years. And so the long play are the ones that are going to walk away with millions, not thousands or hundreds. And to the question here that was around, are there models, tools to tell how much is on your portfolio? I mean, certainly that's going to come down to, your internal compliance definition and the policy that you build around synthetics. But I think using general guidance, if you take a third-party tool, obviously I would speak to ours using synthetic fraud. What I've seen customers do in the past, they usually do two things. First, they're going to scan their whole portfolio. They're going to understand the existing synthetic fraud that's lurking inside of it, that may be making on-time payments, maybe not even doing any activity whatsoever. You don't know why they're there, honestly. You don't know. All you know is that you probably don't have a genuine ID that was used to open that account. And so then from there, you start working your way through the policy of what will be the next step action you'll take. And then secondly, they go and install something for their origination their account opening process. And then thirdly, they finally get around to touching up their marketing channels and ensuring that they don't have new marketing that's going out to synthetic IDs and making it easy for them. You'd be surprised how many times all the advice for CPN makers and so forth out there is as soon as you buy one of their IDs, they want you to go out there and set up airlines rewards. They want you to get a music streaming service. They want you to get a video streaming service, anything that you can get out there so that you start getting served up marketing content and building up the profile of that ID. So that ends up being a lot of times, I think, the last stage where they realize that they're actually seeping into their marketing and they need to cut that off as well. Julie, anything you'd add to that for those that might have them already on their book?
No, I think you've covered it covered it off well. Yeah, I do. A few of the FIs and fintech lenders that I had interviewed had gone through this exercise. One of the fintech lenders did it internally and really was, looking across identities for that consistency that you were talking about, Lee. A couple others brought in third-party consulting firms to do that analysis for them. And I can say in every one of those cases, 2 were credit card issuers, 1 was a fintech lender. The percentage of their credit write-offs that they found to be synthetic were in the low teens. So, pretty big numbers there.
Yeah, no kidding. And I'm sure all of them, with skilled data scientists that were probably surprised to find that as well, just because that a lot of times synthetics are attempting to use your policies and processes against you. Real quick with the last minute here, Julie, maybe do you have any thoughts? This is a recurring one that I've seen on why there would be false positives in ECBSV, or why it's not just a single best solution that'll just fix it all for us.
Well, the big reason, that the major cause, is the fact that as the pilot is structured currently, there is no fuzzy matching. So, with no fuzzy matching and, with fat finger errors on the application, and also, some data errors within the SSN records themselves, the estimates I've seen are anywhere from 10 to 15% false positive rates. And then also you'll have issues that fuzzy matching wouldn't really help you with, but things like name changes. And, there's going to be a lot of mismatches due to name changes. So again, with a 10 to 15% false positive rate, you need to look at it as one of your tools in the funnel, but probably one that's a bit further down.
Yeah, couldn't have said it better. Thanks for the insight, Julie, and thanks for the research here. I hope you all found it extremely valuable. If we didn't get to your question, we'll make sure we follow up with you after the session, and really appreciate your participation today.